Value investors are those looking to buy high-quality assets when they are cheap. But what does cheap even mean? To answer that, we must discuss the idea of a benchmark. A benchmark is merely a reference point. In equities, a benchmark is usually a price-earnings or PE ratio. PEs are numbers that typically range between 5 and 100. The specific calculation is the price per share divided by estimated earnings per share 2 years from now. Let's start with a famous stock index, the S&P 500 or SPX. The aggregate price-earnings ratio of all the companies in the SPX is around 23. Any stock with a price-earnings ratio below 23 is considered cheaper than the market. A stock with a PE of 10 or 12 might be described as a value stock because it is much cheaper than the market. But just because a stock has a lower PE than the market doesn't make it a good investment. It could be a public utility company that grows revenue and earnings at a much slower rate. On the other hand, if a stock has a PE ratio higher than SPX, it could be considered expensive. Again, expensive doesn't necessarily mean you should avoid the stock. Companies with high PE ratios often have strong growth prospects. Most big tech companies have PE ratios above their benchmarks. The point here is that value investing has its own jargon, and it centers around whether an asset seems cheap or expensive. That can be compared to a benchmark like an index or the historical range for the stock's PE.